Today we are launching the 2019 World Economic Situation and Prospects Report that assesses current developments and outlook for the global economy. The report, coming out just before the start of the world's business and economic leaders meeting in Davos, provides us an in-depth look at the trends that will affect people's lives in 2019. With us here today are Elliott Harris, the UN Chief Economist and Assistant Secretary General for Economic Development, and Dawn Holland, the Chief of the Global Economic Monitoring Branch for the Department of Economic and Social Affairs. We'll begin with Mr. Harris.
Thank you very much. Good morning, ladies and gentlemen. My colleague Dawn Holland and I are very pleased to be able to present to you this year's World Economic Situation and Prospects, which is one of our flagship publications in the Department of Economic and Social Affairs. The World Economic and Social Prospects is a joint publication that benefits from the economic expertise collected across the entire United Nations system. That includes not only DESA, but the 5 regional commissions, UNCTAD, as well as other bodies such as the World Tourism Organization and the International Labour Organization. The report lays out the economic context and the challenges faced by policymakers in the context of delivering the 2030 Agenda for Sustainable Development. This year's edition of the WESP paints a picture of significant disparities. On the surface, the world economy remains on a fairly steady trajectory, moving into 2019. According to the headline figures in the report, economic activity around the world is projected to expand at a steady pace of about 3%. Yet a closer look beneath the surface reveals significant issues with the foundations and the quality of global economic growth. Growth is uneven, and it is often failing to reach the countries and the groups where it is most needed. Per capita incomes will stagnate or grow only marginally in 2019 in several parts of Africa, Western Asia, and Latin America and the Caribbean. At the same time, the world economy is faced with a confluence of rising risks with the potential to severely disrupt economic activity and inflict significant damage on longer-term development prospects. Over the past year, international trade tensions have escalated, particularly between the US and China. Public and private debt levels have risen to historic highs, and financial vulnerabilities have increased amid these elevated debt levels and tightening global financing conditions. While the adverse effects thus far have been largely contained, these factors cast a shadow over the outlook for 2019 and beyond. These short-term risks are compounded by the waning support for multilateral approaches. Pressures and tensions have materialized not only in international trade, but also in the area of international development finance and climate change. Small developing countries, low-income countries, and least developed countries are particularly vulnerable to a broad withdrawal from multilateral approaches to policy making on the global scale. In the case of a downturn in global economic activity, policymakers around the world will struggle to react forcefully because monetary and fiscal space in many countries is now much more limited than it was at the outbreak of the global financial and economic crisis a decade ago. And given the waning support for multilateral approaches, coordinated action in response to the shock, or any shock, similar to the response to the global financial crisis, may be more difficult to achieve. Alongside the various short-term risks that I've set out, there is an increasing urgency to deal with much more fundamental problems. What we have hitherto viewed as long-term challenges such as climate change have now become increasingly short-term risks. In recent years, we've seen an increasing number of extreme weather events that have had a particularly damaging effect on vulnerable countries, including many least developed countries and small island developing states. Building resilience by supporting the most vulnerable countries to invest in climate-resilient infrastructure is as important as rebuilding after a disaster. There has been progress, yes, but efforts need to be stepped up to ensure that we are adequately responding to these critical challenges. This also underscores the importance of accelerating the mobilization of resources for sustainable investments. Before my colleague Dawn Holland provides you with more details of the report, I'd like to stress 2 final points. First, The world is faced with a whole range of problems that are truly global in nature. One of these is climate change. The essential transition towards sustainable consumption and production patterns is simply not happening fast enough. Our economies remain far too dependent on carbon, energy, and the use of resources. We need much stronger links to decouple, to delink economic growth from environmental degradation. And this means shifting our resources away from investments in the old brown technologies toward investments in new, more resource-efficient and low-carbon technologies. Second, these global problems cannot be addressed by individual countries acting alone. We can only confront the risks to the global economy and the associated development challenges through collective action and cooperative approaches. A withdrawal from multilateralism would pose further setbacks for those who are already being left behind. The current challenges to multilateralism stem in part from the fact that the gains from globalization have not been equally shared, and the needs of many people are not being met. The solution, however, is not to withdraw into unilateral action. Instead, we should focus on strengthening the system, dealing with these shortcomings, in the full understanding that this is the best way to deliver on a sustainable future. Thank you. We pass it over now to Dawn.
Thank you very much. So I would like to start by just reviewing some of the key messages that Mr. Harris has already introduced. First of all, the concept that on the surface, the headline figures that we see for the world economy appear relatively steady or stable, robust. But as soon as you look beneath that surface, the alarm bells start to ring, and it's clear that risks to the outlook have risen notably. There are increasing risks that threaten the short-term outlook in the form of trade tensions, financial fragilities, and climate risks. And at the same time, economic growth is uneven and often failing to reach where it is most needed. And finally, and more fundamentally, there are underlying vulnerabilities and shortcomings in the quality of growth that endanger its longer-term sustainability along financial, social, and environmental grounds. So what do we see on the surface? In our baseline scenario, the global economy is projected to expand by 3% in 2019 and 2020. This compares to 3.1% growth in 2017 and 18, so it's only a marginal slowdown compared to what we've had in the previous 2 years. Growth rates in many developed economies are still operating close to what would be considered their long-run potential, and unemployment rates in many countries have dropped towards historical lows. And among developing countries, East and South Asia regions remain on a strong growth trajectory, and many commodity exporting countries have also seen a gradual recovery despite being vulnerable to continued volatility and increasing volatility in global commodity prices. But at the same time, there are increasing signs that global growth has reached a peak in early 2018. Growth in the United States is projected to decelerate from 2.8% in 2018 to 2.5% this year and to 2% next year as the impact of fiscal stimulus wanes. And risks in the EU in the European Union are tilted to the downside, and growth in China is expected to moderate from 6.6% in 2018 to 6.3% this year, with policy support partly offsetting some of the negative impacts from global trade tensions. But in the world economy is also facing a number of risks with the potential to disrupt economic activity in both the short term and over the longer term. Some of these were already highlighted, so we see waning support for multilateral approaches, the escalation of trade policy disputes, financial vulnerabilities, and also rising climate risks. From a macroeconomic perspective, a major concern is the rising level of debt. Debt levels in both developed and developing countries are well above the levels seen in the run-up to the global financial crisis. In many developing countries, the risks to financial stability have increased, And countries with large dollar-denominated debt, high current account and fiscal deficits, and significant external financing needs are particularly vulnerable to rising global interest rates and a further appreciation of the US dollar. In the context of this limited policy space and high levels of debt, financial stress could be triggered in individual economies by any number of events, including global trade tensions themselves, monetary policy adjustment in some of the large developed economies, commodity price shocks, policy disruption in Europe, for example, associated with Brexit, the withdrawal of the United Kingdom from the European Union, or domestic political and economic disruptions. So there's potential for shocks from many channels, which could hit economies that are already at risk of deterioration. Looking at GDP in per capita terms, it's clear that several countries and regions have not been sharing in the upturn of the global economy. Economic growth is uneven, often failing to reach where it is needed most. Per capita incomes are stagnant or growing only marginally in several parts of Africa, Western Asia, and Latin America and the Caribbean. And that stands out quite clearly when you look at it in map form, as the picture behind shows. So what's common about some of the countries that are lagging, where growth is lagging behind the national average, the global average? In 2018, there were 47 developing and transition economies that recorded GDP per capita growth of less than 1%. These countries are home to 1.1 billion people, 15% of the global population. So declining or inadequate income growth, coupled with high levels of inequality, poses an enormous challenge in these countries as they strive to reduce poverty, develop essential infrastructure, build resilience, and support economic diversification. The majority of the countries with weak or negative GDP per capita growth last year have also seen weak growth for the last several decades. So they've been continuously lagging behind for the last couple of decades. The majority of them are highly dependent on commodities, which stresses the importance of both economic diversification and effective management of natural resource wealth to tap into its development potential. Several of the countries that are lagging behind have also suffered from long-standing armed conflict or civil unrest and political instability. Deep inequalities in the distribution of income also hampers progress towards the Sustainable Development Goals, including, for example, the eradication of poverty. In Africa and in the least developed countries, reaching this target of eradicating poverty by 2030 will require both double-digit GDP growth, so GDP growth rising above 10% per annum, and steep reductions in inequality. So the level of inequality in many of these countries needs to actually halve from its current position. This is well beyond both historical precedents and our short-term forecast. So just to give some context in terms of the challenges that are before us. In recent years, we've also seen an increasing number of extreme weather events, which have had particularly severe impacts on several vulnerable economies. And a crucial element that we need to address in this challenge is a fundamental shift in the way that the world powers economic growth. Economic decision-making needs to fully integrate the negative climate risks that are associated with emissions. This can be achieved through policies, for example, such as carbon pricing measures, energy efficiency regulations, such as performance standards and building codes, and changes in subsidy regimes. Governments can also promote policies to stimulate new energy-saving techniques, such as research and development subsidies. And finally, in countries that remain highly reliant on fossil fuel production, the economic diversification is vital and urgent. that concludes our main summary of our points. Thank you very much, and pass back.
Thank you, Dawn. And now we'll go to questions. Please state your name and media organization. Edie?
Thank you very much for giving this briefing on behalf of the United Nations Correspondents Association. Welcome, and again, we're grateful for your doing this. My name is Edith Lutterer from the Associated Press. I have two initial questions. Christine Lagarde, the head of the International Monetary Fund today in Davos, dropped the IMF forecast for growth this year from 3.7% to 3.5%. I wonder why the UN forecast is even lower than that. And secondly, China announced today that its growth in 2018 slowed to 6.6% from 2017's 6.9%. And I wonder if you could comment on that.
I'll tackle the specific questions on the growth forecasts. So the first thing to bear in mind when you're comparing UN forecasts to IMF forecasts is that we aggregate countries in a slightly different methodology, which has nothing to do with the underlying forecasts in individual countries. They use what we call PPP, or purchasing power parity weights, to group countries together, whereas we use market exchange rates. Long story short, what that means is they have a higher weight on rapidly growing countries such as China and India, and lower weight on developed economies, which means that the average is about 0.5 percentage points higher. So they have forecast, the IMF is forecasting a 0.2 percentage point slowdown in aggregate world GDP growth for this year. We're forecasting a 0.1 percentage point slowdown. So the differences are actually very small, marginal, almost a rounding distinction. I would say that one of the factors that does distinguish our forecast, which is, in fact, I would qualify it as slightly more optimistic than the IMF's outlook, is that our forecast is predicated on an assumption that China and the United States find some common ground in their negotiations over the coming month, and so that there is no further rise in tariffs come March, whereas the IMF have already factored in an expected rise in tariff rates at that time. So that would be one of the crucial factors that distinguishes the specific numbers in the forecast. On China, China's slowdown to 6.6%, I think, yes, that's right, is largely a reflection of a longer-term shift towards towards a more sustainable path. Which includes an increase in domestic demand, in consumption, offsetting slower growth in investment and export-driven growth. That's largely a policy-driven choice, and is putting the economy on a longer-term, more sustainable path.
Thank you. Carla, stay.
Sorry. Hi. Thanks, Dan. Sorry, Carla. James Ronald with Middle East Eye. A question specific to that region. Your forecast is, for example, steady growth for the GCC section of the Middle East. Syria, Iraq, Yemen, rather obvious because they're war-ravaged. But you pick out three countries, Turkey, Lebanon, and Jordan. You're a little bit gloomy on the prospects there. What is it that those three countries have in common, and what should the folks in that country be thinking about the year ahead, and why?
I guess first I would start by saying I would really like to refer you to my colleague Yasuhisa Yamamoto for details on the individual countries in the region after this discussion. But I would say that I don't think there's necessarily a common feature that is having an impact on the three that you highlight. Turkey is suffering from some specific balance of payments issues and sharp depreciation of its exchange rate, which is not common to the other two countries that you mentioned. They are the two that you highlight are also oil importing countries, which so are sensitive to the ups and downs in commodity prices. But again, I think I should refer you for specifics to my colleague after the.
If I could add in there, one feature of both Lebanon and Jordan that explains some of the difficulty that they face is that they are both host to simply tremendous numbers of refugees, accentuated by the Syrian crisis. And this has presented a tremendous burden to the fiscal accounts of both countries over the last 2 years, and this has been accentuating over the last 18 months. Now, what that has meant is that in many respects the countries are not able to conduct the usual types of fiscal policies, including government investments, that could sometimes contribute to strengthening the growth performance going forward. And this is a challenge for the international community because, in essence, by providing a safe haven for these refugees from war-torn countries, these countries are taking on a sacrifice on behalf of the global community. And there is a definite, clear manifestation of the impact that has on their domestic economies, which I think we in the global community need to take into account going forward. Thanks.
Take questions for Dawn. You mentioned and could you possibly be more specific about which countries they are, where the conditions of growth are so poor that they would need to exceed 10% growth? Do you think that they could accomplish this if it were possible to do?
Great question. Thank you. I have to say it is possible to do because otherwise we would be setting targets that we can't achieve. So in particular, where I'm looking at the target of eradicating poverty by 2030, which is the very first of the Sustainable Development Goals. And looking in particular at regions with very high levels of poverty, so in particular in Africa and sub-Saharan Africa. Under current projections, where growth is averaging something around 4%, 5%, maybe on the optimistic side per year, and inequality is more or less stable or declining very marginally on a year-by-year basis. Just this pure mathematics of that mean that by 2030, we're still going to see 30% of the population in Africa living in extreme poverty. So what needs to change to change that outcome is we need much faster growth and we need much sharper declines in inequality. So that's the particular region, and also in least developed countries, many of which are in sub-Saharan Africa, but also in other parts of the world. That is the set of countries where we need to see those targets hit. How do we get there? Well, we need to raise investment rates in Africa dramatically over the next coming years. We need to be able to finance that. That's a huge challenge. We need to find new sources of finance, expanding tax revenue. Tax rates are very, very low. The capacity to secure government revenue is relatively limited in many countries, and often tied very closely to natural resource wealth. natural resource wealth needs to be better managed than it is. That, I think, is one of the most crucial things that we would promote. Many of the countries that are lagging far behind are countries that are home to vast natural resources, have the potential, huge development potential. But managing these resources well is crucial to ensure that finance gets channeled in a way that supports society at large, rather than just into a narrow set of interest groups, or even being sent abroad where it's doing little to support the domestic economy.
I have a follow-up question. I recently saw Philip Alston's report on the austerity measures in England increasing the rate of poverty, and austerity measures are being imposed throughout Western Europe, which in many countries has led to riots and is likely, it would seem, to follow the path that Alston has exposed in England. Would you include some of these Western European countries as deteriorating to a point where they may be facing situations of extreme poverty by 2030?
For good reasons, there are many different definitions of poverty, and each national country has its own definition of poverty with different poverty levels. The international definition of extreme poverty is one where the income level is $1.90 in purchasing power parity terms per day, which is something that we don't see in countries in Europe, and is unlikely to be something that arises in the near future in Europe.
Yes, Frank?
Hi, Prekis here at TRT World. In the headline of your press release here, it says economic prospects threatened by weakened support for multilateralism. Can you give me some specific examples of that and what led you to put that in the headline?
I think the most glaring example are the trade disputes that are going on. We have a multilateral trade system embodied within the World Trade Organization, and that foresees a measured approach to dealing with any sort of disputes on the policy side or in actual practice. What we've seen happening increasingly over the last few years is that the dissatisfaction with the way in which that part of the system is working has led first to a rise in bilateral and plurilateral arrangements concluded outside of the framework of the WTO, and then unilateral action in response to perceived problems. Now, that goes against the very spirit of the multilateral trading system, and it shows that there is a sense that the system itself is not responding to the concerns that the member states have. This is legitimate, that concern, but what we think should happen is that one should recognize where the multilateral system is failing, where the institutions may need to be improved, and one should devote time and effort to strengthening the system so that it can perform the way it's expected to perform. Instead, what we see happening is a growing tendency to look out for oneself first, instead of staying within that framework of collaborative and cooperative action. This is understandable from a certain point of view because in many respects there has been a growing dissatisfaction with the consequences, if you will, of our global economy over the last decade or so. It's quite clear, and I think Dawn pointed out, the overall way in which the economy performs globally is not mirrored at individual country levels. So you have some countries that are doing reasonably well, but others that aren't. By the same token, income levels are varying across the world. Inequality has risen within countries. And what we see happening is that more and more people are registering dissatisfaction with the outcomes of our global system without having their policymakers explain to them what actually is going on. And so that frustration then makes for a growing readiness to, let's say, be receptive, if you will, to nationalist arguments, to saying, let's do what is best for us individually, as a country, as a nation, rather than the support for the multilateral approach that we've seen over the past 40 years. And we think that that is a real problem because it does undermine the ability of the world to deal with some of our global problems in a collective manner.
Do Do you think this is going to make it more difficult down the road for some countries to pay their dues to the UN?
Fiscal policy of each country. They have to decide to make sure that they respect the international obligations that they have. There is an awful lot hanging from the support to the UN system. It is not just the economic work that we do or the social work that we do, but a lot of the peace and security that is still a problem in many parts of the world can only be addressed through the UN. Support for the UN provides the necessary underpinning, if you will, for that collective action to deal with a whole range of problems. Now, I do think that it is within the prerogative of every country to decide how it uses its resources, but I do think it's also part of the responsibility of every government to take a clear and sober look at what the country's international obligations are and to make sure that the critical obligations are respected.
Yes.
Hi, my name is Xuan Ling, and I'm from China's Xinhua News Agency. And you have already commented on the China's GDP, which gave us out yesterday. And can you actually the change of speed of China could affect the country's export a great deal to it. And what do you see if that's going to happen as a whole to the world economy? And my second question is that what do you say about the financial debt level in 2019? I mean, the trend as the world financial stress goes up or down in the future? Thank you.
So on China, what's the impact of a slowdown in China on world exports? I think is what you're driving at. So a slowdown can happen through many different channels. So China's a very, very open economy, has a very high level of trade compared to many other economies, and the production is also very deeply integrated into global production networks or value chains, particularly within the East Asian region. So if the slowdown in China is specifically driven by tensions in global trade, so in a slowdown in exports, then this could have some deep repercussions, particularly within the region, but also globally. For example, so GDP is projected to slow down only marginally this year, from 6.6 to 6.3%. But if that represents like a 10% drop in the level of exports, with a comparable drop in the level of imports, it will have a much bigger impact than if it's a small change in the domestic economy, for example, in a small adjustment through household consumption. So the impacts differ depending on the source of it. A prolonged and escalating situation in the global trade tensions could have indeed a dramatic impact on both global trade and world output. I'm sorry, I was concentrating on China. Can you just reiterate the gist of the question?
When you just introduced the report, you said the financial stress is going to be tremendous on the next year, right? So can you elaborate that, please?
So we're in a position where global interest rates are rising. And when debt levels are high, that has an impact on debt servicing costs. When debt servicing costs reach a certain level, countries can come under stress if they may find it difficult to meet the financing needs of covering their interest burdens. So this is more likely to happen in an environment where interest rates are continuing to rise, and particularly countries that have taken out a lot of debt in foreign currency, in US dollars, which is the most common currency to take out foreign exchange debt. If the dollar strengthens relative to their domestic economy, the cost of financing that interest burden increases all the more, and you can get this sort of circular impact, which can push countries towards debt distress.
And there's another aspect to this as well that we need to keep in mind. Over the past 10 years, as interest rates have been at virtually zero, in some cases even in negative territory in major advanced economies, a lot of private capital has left those economies and gone into emerging markets, in particular in the search of yield. Now, as we see the interest rates start to rise again, there's a certain part of that capital that's been lodged abroad that will be brought back in to take advantage of the rising interest rates in the home markets, if you will. And that reversal of some of those flows could provide a trigger for some degree of financial volatility in those markets which are suffering from other sources of fragility as well. So one of the things that we see as a potential stress on the overall financial situation is, in essence, the normalization of monetary policy in many of the advanced economies after 10 years of really exceptional approaches to sort of stabilizing the global economy. So that is one additional source of concern that we're looking at. We also see a bit of a problem as well in some of the, if you will, in the need for us to shift our investment patterns away from the typical and traditional types of flows that we've had. There's an increasing interest, I think, among major investors, including institutional investors, in looking at longer-term investments, investments that are considered to be consistent with sustainability, investments that sort of enable this transition away from the unsustainable patterns of consumption and production that we were talking about earlier, towards the kinds of new low-resource or resource-efficient economic production, low-carbon economic production. And let us not forget that in many cases, these changes are going to be quite fundamental for some economies. And as we see these decisions being taken increasingly, decisions that have to be made if we want to reach the 2030 agenda, we also have to take into account what that might mean for the industries and the sectors that might be losing out on some of the investment flows that they've had in the past. This is a transition that's going to be painful in some cases. It's necessary, but I think that is an area of potential, how should we say, turbulence that policymakers need to be aware of and they need to take into account as well, both to enable the transition to happen more rapidly, but also to deal with the aftermath of the transition in those areas that will inevitably be, if you will, in decline. Thanks.
Okay, any other questions, quick ones? Okay, well, thank you very much. And if you need any further information or want to arrange interviews, let us know. Well, thank you very much.